Have you ever been in a conversation with someone about multifamily investments and they're using all kinds of acronyms and abbreviations and industry jargon, and at the end of the conversation you're like, what? Hey, it happens to me too, and I've been in this business for 20 years. In this video, I'm going to teach you how to talk apartment nerd. Are you ready? Are you ready? Let's go! All right, so we're gonna break the jargon all up into 5 different categories: deal flow, debt, due diligence, financial, and a miscellaneous category. First up within the deal flow category is BOV, or broker opinion of value. That is exactly what it sounds like. It's when someone asks a broker to give their opinion of value on the asset. Now, it's just not something you dream up. We actually get the financials and do a full underwriting of the deal, and then we tell you what we think the value is on the asset. Next up is OM, or offering memorandum. That's simply the marketing package that the broker or the seller puts together so that you could do your evaluation. A seller or a broker may ask you to sign a CA, confidentiality agreement, or an NDA, a non-disclosure agreement. They're both the same thing. It's basically a document that is from the seller that basically says, hey, I'm going to give you financials to my property. You're going to use them to evaluate. You're going to talk to your team members, but you're not going to send them around to the world or there's going to be repercussions. Then you go to an LOI, or letter of intent, or MOU, memorandum of understanding. Those are both the same, and that's simply a non-binding agreement, usually 1 to 3 pages long, that spells out all the major terms of a deal without having to get heavily involved with hiring a bunch of attorneys to create a big old contract. Now, a PSA is a purchase and sale agreement. That is the binding agreement between buyer and seller to go into a deal together. You may be asked to put an EMD down, or earnest money deposit. That's simply the initial deposit you put down in order to secure the asset when you go to contract on a property. And the last abbreviation within the deal flow category is DD, or due diligence. That's simply the inspection period that you go into once you go to contract on a property. Now we're going to jump into the debt category of abbreviations, and first up is the DSCR, or debt service coverage ratio. The debt service coverage ratio is a measurement of risk by the lenders when they're giving you money. Typically, they want you to have at least 1.3 times more net income in order to service their debt. Let me show you the equation. So the equation is net operating income divided by annual debt service. In our example, if you have $567,000 in net income divided by $354,000 in debt service, which is the principal and interest, then this particular property has a 1.60 debt coverage ratio. That would make a lender feel good because you have 1.6 times more net income left over after all the expenses in order to service their debt. Next up is IO, or interest only. Sometimes a lender will quote that they'll give 2 years of IO, and that just means that they're going to give you 2 years where you can pay just interest only. Next up is BPs, or basis points. 1 basis point is equal to 1/100th of 1%. Sometimes lenders will quote interest rates as a basis point above LIBOR. So they may say, we are lending 80 basis points above LIBOR. That means 0.8% above the LIBOR. Now, of course, next up is LIBOR. What is LIBOR? It is the London Interbank Offered Rate. I want to make sure I got that right. It's just a globally accepted rate that is the basis from which lenders lend on top of. And LIBOR is simply the rate at which banks lend to each other on. Next up is non-recourse debt, which is basically just debt that's secured by an asset instead of you personally. So if you default, the lender doesn't come after you, they have your property. If you hear the words capital stack, that's just the debt and the equity that you use to buy a property. If you hear the words Mezz Debt, or mezzanine debt, that's just the debt that typically developers get to bridge the gap between a primary mortgage and the balance of the equity needed to do the deal. So if a developer could only get 80% from a primary mortgage and he needs another 20%, maybe he can borrow 10% from a mezz lender, which is usually at a higher interest rate, because the primary mortgage in the event of default is the one that gets to come after you first. And if there's anything left over, the mezz lender gets the balance, which oftentimes there's not, and hence why the interest rate's higher. Then you have defeasance. Defeasance is basically just a prepayment penalty. If a lender gives you money, they expect a certain rate of return over a certain period of time, and if you want to pay that off early, they make you pay a penalty so that they can make up for those returns. And the last under the debt category is bridge loan. That's just a short-term loan against another property that you own that has equity that you can then use to put down on another property or buy another property. By the way, if you're getting value out of this video so far, hit the like button down below. It helps me a lot in the algorithm, and please subscribe if you haven't already. Now we're in the due diligence category, and the first item up, you might hear hard costs. Those are simply the material and labor costs that make up the physical asset of a development, the actual buildings. Now, soft costs are things like architecture fees, engineering fees, CPA, attorneys, permits. A CO is a certificate of occupancy. It's just a document that says it's safe to enter into the building and live in it. A TCO is a temporary certificate of occupancy, which basically just says that there's only minor things left to complete the building and it's safe to actually occupy it. Now we're in the financial category, and first up is underwriting. When someone says they're underwriting, that means that they're actually doing the financial analysis of the purchase of the property. You will hear cap rate all the time. That stands for capitalization rate, and it's just the rate of return of a property in a 1-year time horizon as if you were to pay cash for the property. The calculation is net operating income divided by purchase price times 100. So if you have $150,000 in net income and you purchase the property for $2.7 million and you use no loan whatsoever, that's a 5.56% cap rate or rate of return for that exact period in time. If you hear pro forma, that's just a projection of what one thinks the future income and expenses and sale price could be. The abbreviation NOI is net operating income. That's just income minus expenses. Then you have EBITDA, which is earnings before interest, taxes, depreciation, and amortization. It's just a fancy accounting term typically used in business, but it's equivalent to the net operating income that we just explained. Then you have COC, which is cash on cash, which is just net operating income minus debt. Next up is IRR, or internal rate of return. This is my personal favorite because it gives the true long-term measure of the performance of a property. Let me drive home the example of an IRR since it measures the full life of the property. Let's assume in year 0, which is right now, you buy a property and put down $539,000. That's why I have the negative sign there. Then in year 1, it produces $43,000 in cash on cash, remember, which is after expenses and debt. Year 2, $46,000, and in year 3, you sell it and walk away from closing with $1 million in your pocket plus the cash flow. If you were to create a rate of return over that 3-year period, the Excel spreadsheet would calculate that it's 28% per year. That's the IRR, and you typically need spreadsheets in order to do the calculation. Then you have ROI, or return on investment, which is just the increase or decrease of value over a set time. Let me explain. The equation for ROI is your current value right now minus what you bought it for plus all the renovations you put into it divided by what you bought it for and all the renovations times 100. So as an example, if the current value of your property right now is $10 million and you have $7,200,000 into it, then you would multiply that equation and you'd come out to 39%. Essentially saying that over the period of time you're analyzing it, your value has increased 39%. Now the problem with ROI is it doesn't take into consideration time. A 39% return in 3 years is probably pretty good. If it was a 39% ROI over 40 years, may not be so good. Next up is Capex, or capital expenditures. Those are just one-time expenses like roof and air conditioner, floor, appliances. If you hear Opex, that's operating expenditures. That's the regular maintenance of the property like lawn and pool and repairs and maintenance and utilities. If you hear BE ratio, that's break-even ratio. Also one of my favorite calculations. Let me show you how it works. Okay, the break-even ratio is basically a measure of what occupancy you have to be at in order to cover all of your expenses and debt. So the equation is expenses plus debt divided by total income, and of course times 100 to get to the percentage. So assuming you have $688,000 in expenses and $354,000 in annual principal and interest payments, divided by $1.3 million in total income, that means that you have to have at least an 80% occupancy in order to cover all the expenses. Now, on a lot of income statements, you may see a line called loss to lease. Loss to lease is simply the difference between the market rent of a property and the current in-place rent for a specific unit. Now, the last term to define under the financial category is GRM, or gross rent multiple. Let me show you how it works, and then I'll tell you when it's used. The gross rent multiple is calculated by the sale or purchase price divided by the gross annual rents of a property. So if you have a $10 million property with gross rents of $1,275,000, the gross rent multiple is 7.84. It just means that a property is trading for 8 times the gross rents. Now, the way I use it is more in a macro sense. If I'm tracking a certain type of property in a market and there's 40 or 50 closings and all of the GRMs are around 8 or 9, and I'm doing a BOV on one property, I don't use the GRM to price that one property, but when I'm valuing that one property, I like to compare it to 30 or 40's GRM just to make sure I'm in the same ballpark. Now we're in the final miscellaneous category of weird acronyms, and the first one up is the most weird of all: Frothy. This is when investors are ignoring market fundamentals and are paying more than a property is probably worth. Many would say that today's market is frothy. If you hear syndicate or syndicator, that's just a group of people who have pooled their money together to invest or buy other assets. If you hear absorption rate, that's just the proportion of new construction units that have leased in a certain period of time. So if 100 units were being constructed and 40 of them leased, that's a 40% absorption rate. Affordable housing is a property in which the tenants are receiving some sort of rent assistance from the government or other organization. A soft market is when supply exceeds demand, and in that scenario, usually a tenant or buyer can get a pretty good deal. We are not in a soft market right now. A turnover rate is just the percentage of units that became vacant during the year. So if you have 10 units and at some point during a 12-month period, 4 units moved out, that's a 40% turnover rate. If you hear someone say, yeah, that property's gonna be a Dispo next year, Dispo just stands for disposition. That just means someone's gonna be selling a property. A JV is just a joint venture. That's when 2 or more people get together and they collaborate on a deal. If you hear MSA, that stands for Metropolitan Statistical Area. That's just a larger area beyond where you live. So for instance, if you lived in Miami, you probably visit West Palm and Fort Lauderdale quite a bit, and so that would be your MSA. If you hear T12 or T6 or T3, that just means trailing 12 months. So if you're looking at financials and you want to ask for the T12, that means you want to ask for the last 12 months, month by month, of income and expense. Woo, there's a lot of abbreviations and acronyms in our business. Thanks guys for sticking around, and I'll see you on the next one.